If you invested $100,000 into Fidelity index funds today, how much money would you actually make? Most people assume that hitting the $100,000 milestone is the ultimate "I'm set for life" button. They imagine a life of leisure where the passive income covers their mortgage, their car note, and their groceries without them ever having to lift a finger again. But the real numbers behind Fidelity index fund returns are often either much better or much worse than people expect. I ran the actual math using historical data and current yields to show you exactly what happens to that money. Depending on which strategy you pick, there are 3 very different outcomes for your bank account. If you think $100,000 is enough to retire today, you might be in for a massive shock. But if you understand how to use it as a wealth accelerator, the results are staggering. There is a common myth that everyone seems to believe once they start looking at their brokerage account. We see it all over social media and financial blogs. The idea that a $100,000 investment is the point where you've basically made it. People treat this number like a finish line. The fantasy is that once you see those 6 figures, the passive income starts flowing in like a waterfall. We've all seen the posts about living off dividends or escaping the rat race with a modest portfolio. But here is the reality check. $100,000, while a massive achievement, usually does not produce the large monthly income people dream of. It is an incredible foundation, but it isn't a private island fund just yet. Before we dive into the hard data, I want you to take a second and guess. If you had $100,000 sitting in a standard Fidelity index fund right now, how much monthly income do you honestly think it would deposit into your bank account? Keep that number in your head, because we're about to break it down. Let's look at scenario number 1, dividend index fund income. Many investors gravitate toward Fidelity because of their low-cost, high-quality dividend funds. You might look at something like the Fidelity High Dividend ETF or a similar total market index. These funds are designed to distribute a portion of the company's profits back to you. Typically, a safe and diversified dividend yield sits somewhere between 2% and 3%. Let's be generous and use a 2.5% yield for our math. If you take your $100,000 investment and multiply it by a 2.5% annual yield, you're looking at $2,500 per year. When you break that down into a monthly check, it comes out to roughly $208 per month. For most people, that is a huge disappointment. You worked incredibly hard to save 6 figures, only to realize that your monthly payout covers maybe a utility bill and a few bags of groceries. This is exactly why so many investors feel defeated after hitting their first big milestone. They expected a salary, but they got a side hustle. However, I'm telling you right now, looking at the monthly check is actually the worst way to measure your returns. That leads us to scenario number 2, average market returns. If you aren't chasing immediate checks and instead focus on growth, the story changes completely. When we look at historical Fidelity index fund returns, specifically tracking the S&P 500 or the total stock market, we see an average annual return of roughly 7% to 10% over the long term. This isn't money being paid into your pocket every month. This is the value of your shares increasing. If you leave that $100,000 alone and let it grow at an average of 8%, you aren't looking at $200 a month anymore. You are looking at an annual growth of $8,000. In 10 years, without adding a single penny more, your $100,000 investment could grow to approximately $215,000. In 20 years, that same amount could balloon to over $460,000. If you have the patience to wait 30 years, you're looking at more than $1 million. This is where the math starts to get exciting. The real surprise doesn't happen when you try to pull money out. The real surprise happens when you stay out of the way and let the market do the heavy lifting. Now we arrive at scenario number 3, compounding with no withdrawals. This is the wow moment that separates the wealthy from the middle class. When people talk about building wealth, they often focus on how much they need to start, but the secret isn't the starting amount, it's the lack of interference. When you have a $100,000 investment and you reinvest every single dividend and never touch the principal, you trigger a snowball effect that is mathematically unstoppable. In the beginning, the growth feels slow. It feels like you're pushing a tiny snowball up a hill. But once that snowball reaches the top, that $100,000 mark, it starts to roll down the other side. Suddenly, your money is making more money than you could ever save from your paycheck. Your $100,000 turns into $200,000, then $400,000, and before you know it, you're looking at 7 figures. This is why the first $100,000 is so powerful. It is the critical mass needed to make compounding feel visible. Once you hit this number, time becomes a much more important factor than your actual contributions. Despite this potential, I see so many people fail. The big mistake most investors make is a psychological one. They fall into the trap of chasing dividend income too early. They see that $200 a month and try to force it to be $2,000 a month by picking risky, high-yield individual stocks or complex funds they don't understand. Or even worse, they see the market dip, panic, and withdraw their money too soon. They treat their brokerage account like a high-interest savings account rather than a wealth-building engine. Another common error is not reinvesting dividends. If you take that $208 every month and spend it on dinner, you are effectively cutting the legs off your future wealth. You are preventing the interest on interest from happening. Expecting massive passive income too quickly is the fastest way to stay poor. You have to understand that there is a growth phase and an income phase. If you try to switch to the income phase before your portfolio is ready, you will stall your progress forever. So what does $100,000 actually buy you in the real world? Let's ground these numbers in reality using the 4% rule, which is a standard benchmark for safe withdrawal rates in retirement. If you wanted to live off your $100,000 investment without ever running out of money, the math suggests you can safely take out 4% per year. 4% of $100,000 is $4,000 a year. That breaks down to just $333 a month. Think about that for a second. $100,000 in the bank gives you the equivalent of a car payment or a very modest insurance premium. When you contrast the expectation of being set with the reality of $333 a month, it can be a bitter pill to swallow. But this reality check isn't meant to discourage you, it's meant to focus you. It shows you that $100,000 isn't the end of the journey, it is the fuel for the next stage. The strategy that wealthy investors actually use is fundamentally different from what the average person does. Wealthy investors don't look at $100,000 and think about what they can buy today. They focus on the accumulation phase. They prioritize low-cost growth index funds, the kind Fidelity is famous for, and they aggressively reinvest every cent. They understand that for the first decade or two, the goal isn't income. The goal is total return. They let compounding work for decades, ignoring the noise of the media and the fluctuations of the market. Only when the portfolio has reached a size where that 4% rule covers their entire lifestyle do they switch to the income phase. They don't try to build a passive income portfolio from day one. They build a growth portfolio that eventually becomes an income machine. It's a subtle shift in mindset, but it makes all the difference in the world. The surprising truth about $100,000 is that it won't make you rich overnight, and it won't create a massive monthly income today. However, it does something even more important. It dramatically accelerates your wealth building. There is an old saying in finance that the hardest money you will ever earn is your first $100,000. Why? Because you have to do all the work. You have to save every dollar from your salary, skip the vacations, and stay disciplined. But after that first $100,000, your money starts doing the work for you. It becomes a secondary employee working 24/7 without a break. Fidelity index fund returns might look small on a monthly basis at first, but over time, they turn a modest spark into a massive bonfire. If you have $100,000, or even if you're just starting your journey toward it, remember that the value isn't in what it can buy you now, but in the freedom it will provide you later. Stick to the plan, ignore the myths, and let the math do what it does best. Your future self will thank you for the patience you show today. Stay focused, keep investing, and I'll see you in the next one.